Hey guys, welcome to another video. As I've promised you that I'll be doing a video on supply and demand theory. So this is it. Let's get started. So a supply zone, it is an area of consolidation, right, that comes before an impulsive move. So what you will see is the market will be moving and consolidating in one area, and then it will make a strong push up, just a small one, just to take out the liquidity that is above the buy side liquidity, and then it will rally to the downside, right? And it is known as bearish price action, or we can refer to it as a bearish order block to be more precise. So what the market usually does, as I said, it will create a range bear market before an impulsive move to the downside, of which will either leave an order block or just a supply zone. Now these zones, actually they act as resistance when price move up into them from the downside, and they can be used to enter short positions and or close longs. What I mean by that, if you have your buy positions, right, and the market is moving up into your supply zone, you can close those buys and then be able to take your sell positions. Okay, so how do we mark off that supply zone? We take the high of the range and the lowest body candle. We take this high of the range, the high of the range and the lowest body candle, or we can take the whole ranging zone, but the most reliable way is to look for the last up candle before the impulsive move to the downside, right? So as I've said, we can take the whole ranging zone, right, and mark it as our supply, or we can take the last up candle before the strong move to the downside which broke structure. Okay, so it is simple as that. Make sure that you grasp it, make sure that you take notes. Okay, so at demand zone we do the opposite of what we do on the supply. So it is an area of consolidation that comes before an impulsive move to the upside, and it is known as bullish price action, right? So this consolidation area comes before the move to the upside, which breaks structure. So we can mark off this whole area as our supply, or we take the last down candle before that strong push to the upside, right? So I'm going to show you an example. So as I've explained, marking off the demand zone, use the same method as when you're using the supply zone. You take the low of the range and the high of the range, or take the whole ranging zone and mark it as your supply, or just take the last down candle before the strong push to the upside which broke structure, and then patiently wait for the market to return to that demand zone, and then you can start looking for your longs. Okay, so let's see. So this is how I basically trade. The market will be moving to the upside. Let's say we are in an uptrend, right? The market is creating low, high, 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 low, high, high, and high, low, high, high, and high, low. And the market basically is going to, at some point, it's going to break this high low. Once it breaks this high low, my bias changes. It is no longer, I'm no longer looking for buys. I'm looking for sells because the market is changing direction, right? So what I've learned in the years that I've been trading is that once the market breaks structure, the whole bias changes, right? We will be looking for sell positions. Okay, so what you have to do is wait for price to return to your supply zone or your demand zone, right? When the price returns and mitigates that area, what you have to do is go to a smaller time frame. You will realize something, you will see something like this. Price will be moving and then creating high highs and high lows, high highs and high lows. You have to wait for a break of structure or a change of character and identify your second supply zone of which you will be entering your trades on. Because entering trades on a higher time frame supply is it's risky. So taking a confirmed entry on a small time frame, it's more and less risky because the stop loss is going to be tiny. Okay, so when you identify your supply zone or a demand zone, make sure these three things are there. Make sure you see liquidity sweep or liquidity in the market. Make sure there is imbalance. And some of these things, I'll explain them. I'll make a video on imbalance and liquidity if you don't understand what I'm talking about. Make sure there is break of structure. You've heard me right. Break of structure, liquidity sweep, and imbalance. These three things must be evident when you are identifying your supply zone or your demand zone. Okay, so I'm going to give you an example on how to mark off your demand or your supply zone. So here's an example. We have a low right here. Okay, then the market creates a high, then we have a higher low. So as the market enters the territory of this high, it breaks that high, which becomes our break of structure, right? So you mark this, the last down candle before the strong push to the upside, which broke structure. You mark it off as your demand zone. Okay, and you do the opposite when you are looking for a supply zone. We have a high, markets creates a low, it reverses and fails to take the high, it creates a lower high. Then the market reverses, takes out that low, right? After taking out that low, you patiently wait for the market to return and you mark the last up candle before the strong push to the downside as your supply zone. When the market enters this territory of supply, you move to a small time frame, look for your break of structure, and look for your supply zone or demand zone on a small time frame. You enter your trades, wait for the market to hit your target. Right? Simple as that.